So I was looking through Yahoo Finance this weekend and I came across this article which caught my eye. It was from Insider Monkey and it is the 10 high yield monthly dividend stocks to buy in August. Now Insider Monkey tracks about 866 hedge funds and lets us know what they're doing, gives us a report on them. But one of the things that you always have to keep in mind when reading what the hedge funds are doing is that we only have a snapshot of that day they had to file with the SEC. They could have blown out of these positions, been long gone by the time you get the information and you buy something because you see that a hedge fund bought it. Now, this is great for putting companies on your radar because you can see what the hedge funds are doing or what they did buy and what they potentially still hold. But do not make the mistake that I did of A, buying something because a big institutional investor bought it, and B, because you read it in a blog post, in a social media post, on Twitter, on YouTube, Reddit, anywhere like that. You have to always do your own due diligence, have your own thesis written down for why you bought something, and do not sell until that thesis changes, your own personal thesis. Now, this is something I wish I had done and known years before, but I made the mistake of buying companies like NRZ, New Residential Investment, and Apple Hospitality REIT, ticker PFLT. And I bought those because I read on a blog post that they were great buys for monthly dividend stocks, and they both got cut, and needless to say, I should have steered clear. Hey, what's up? I'm Russ, and this is Dapper Dividends, where I'm bringing you information every week to help you become a better investor and sharing what I've learned and sharing things that I'm learning as I continue to grow and evolve. But I am, for those of you who don't know, a blue-collar service technician, welder, installer of commercial loading dock equipment. I was brought up without any kind of financial education, and I took it upon myself to learn this thing called dividend growth investing, which I stumbled into after failing at penny stock investing and swing trading and trying to time the market. And I learned the hard way that it is more important to spend time in the market than trying to time the market. The Insider Monkey article is linked in the description below. I would highly recommend you check it out for yourself. But we're going to get into it, and we're briefly going to touch on and look at the 10 high-yielding monthly dividend stocks that they recommended in the article. And we're going to see, as a dividend growth investor, if I would buy any of those. First up at number 10 is San Juan Basin Royalty Trust, which is traded on the New York Stock Exchange under the ticker SJT. They are a Texas-based express trust with a 75% net overriding royalty interest from Southland's oil and natural gas interests in properties in northwestern New Mexico. The stock is down 16% the past 5 years. So right off the bat, we can see, just looking back 5 years, that the stock is down 16%. Now, with a lot of these companies, you're going to see, and I always preach this, that when the companies have a really high dividend yield, but they're trading under $20 or under $10 or sometimes even under $5, as we're going to see, there's a reason, a very good reason, that they are at such a low price. So the Insider Monkey article used a lot of very recent metrics to give these a solid buy rating and to say you should be buying these. And as investors, we must look through the windshield and not the rear view mirror. But the rear view mirror does give us some very, very important clues about how the company has behaved. So while it doesn't tell us exactly where they're going, it is a very good metric to look at how the company has handled their finances and if they have cut or raise the dividend, which over the last 4 years for San Juan Basin, the EBIT, which is the earnings before interest and taxes, is down 82%. The earnings per share is down 81%, and their cash flow is down 76%. Their dividend distribution is down 90% from 2001 to 2020 and is constantly being raised and cut. So just right there, those 4 quick things I looked at, I'm out. I'm not going to do any deeper dive into that because they have no problem with constantly cutting and raising the dividend. So for San Juan Basin, hard no. Number 9, PennantPark Floating Rate Capital Limited, trading on the NASDAQ under the ticker PFLT, is a provider of first lien debt and invests in middle market companies within the United States. The stock is up 1.8% the past 5 years. So at least with PennantPark, their stock is up over the past 5 years. But with inflation, you need to be doing better than 1.8%. Over the last 4 years, going back to fiscal year 2017, shareholders have been diluted 22%. EBIT is down 18%. Their free cash flow is negative, but up 93%, although trailing 12-month free cash flow is only $271.8 million. So they have been diluting shares, which is not the worst thing in the world if they are growing the top line, which is revenue, and the bottom line, which is their free cash flow, which both of those are trending upwards. Now, their dividend is not growing, but I think this one deserves a deeper dive and could be considered a frozen yield dividend stock. So for PennantPark Floating Rate Capital, I would give a thumb sideways and say it deserves a deeper dive. Number 8, Prospect Capital Corporation, trading on the NASDAQ under the ticker PSEC, is a business development company focusing on the middle market, mature, mezzanine finance, later stage, emerging growth, leveraged buyouts, and refinancing areas. The stock is down 2.4% over the past 5 years. We've covered PSEC a few times on the channel, but top and bottom line growth have been relatively flat the last 4 years, and the dividend has been at 6 cents since September of 2017 when it was cut from just over 8 cents. Click the link right here where we've talked about Prospect Capital, and like PennantPark, this is just not for dividend growth investors, and their dividend is currently frozen, meaning that it's not being increased and it's also not being cut, which is okay. But as DGIs, we tend to shy away from those. But if the trend stays true, I would not be surprised by a dividend cut in the next few years. So for Prospect Capital, another thumb sideways, and I would say it deserves a deeper dive and another look. Number 7, American Finance Trust Incorporated, trading on the NASDAQ under the ticker AFIN, is a publicly traded real estate investment trust focused on acquiring and managing a diversified portfolio of primarily service-oriented and traditional retail and distribution-related commercial real estate properties in the United States. The stock is down 38% the past 5 years, and over the last 4 years, top line has grown 9%. Current earnings per share is negative 43 cents, and shareholders have only been diluted 2.1%, and free cash flow is flat. Their dividend was cut from 9 cents to 7 cents in April of 2020, but raised to 21.25 cents in January of 2021, where it is at today. Again, as a dividend growth investor, this is just not going to cut it. But I would give American Finance Trust a deeper look as a speculative play that pays a monthly dividend. So we're going to give them a thumbs sideways. That's 3 thumbs sideways in a row, but it's going to get a little bit bumpier from here. With number 6, Dynex Capital, trading on the New York Stock Exchange under the ticker DX, is a mortgage REIT investing in mortgage-backed securities on a leveraged basis primarily in America. Their stock is down 21.74% the past 5 years. Shareholders have been diluted 27% the last 4 years. Their top line growth is up 63%. Earnings per share is up a whopping 402%. Although it was negative $7.01 in 2019, and free cash flow is down 15%. Now, there's been a lot of dividend cutting going on since 2013 when it was steadily cut from 29 cents to 6 cents in May of 2019. Then it jumped to 18 cents in June of 2019, where it's been cut down to 13 cents, where it is at today. I just can't get away from all the cutting that has been going on with Dynex Capital. So as a dividend growth investor, I give that a thumbs down and I'm out. And getting into the top 5 with Oxford Square Capital Corp, trading on the NASDAQ under the ticker OXSQ, is a business development company working as a closed-end, non-diversified management investment company. The stock is down 21.85% the past 5 years. The last 4 years, their top line has fallen 88%. Net income has dropped a whopping 96%. Earnings per share is down 96%. And free cash flow is down 34%. Now, they have reduced their outstanding shares by 15%, which is great for shareholders as it increases your company ownership. In April of 2019, they began paying a monthly dividend of just over 6.5 cents a share, but cut that dividend 48% to 3.5 cents in July of 2020. Now, if you had a substantial portion of your dividend income coming from OXSQ, that 48% is going to wreak havoc on your patty or your projected annual dividend income. I give a big thumbs down to OXSQ, and I'm out. Number 4, Ellington Financial Incorporated, trading on the New York Stock Exchange under the ticker symbol EFC, works with the acquisition and management of mortgage-related, consumer-related, corporate-related, and other financial assets primarily within America. The stock is up 3.43% the past 5 years.
In the last 4 years, revenue has fallen 35%. Earnings per share has grown 105%.
Net income is down 26%, and they've increased their shares outstanding by 26%.
Free cash flow has grown 125%.
But the free cash flow was at negative $492 million in 2017. Now, Ellington Financial had been a quarterly dividend payer of 77 cents in November of 2014 and cut to 41 cents when they started paying a monthly dividend of 14 cents in March of 2019. But the dividend was cut from 15 cents to 8 cents in April of 2020 and has slowly been raised to where it is today, back at 15 cents. So it's nice to see that their dividend has risen over the last 13 months. And obviously, the COVID-19 pandemic has thrown a massive monkey wrench into the business plans of Ellington Financial. Now, this is one of the more interesting companies that I found on the list, and I would say it warrants a lot more research. But as a dividend growth investor, again, like a broken record, I'm guessing that the dividend is going to hover at 15 cents for some time, but I am definitely going to be keeping my eye on Ellington Financial, and if they start raising that dividend again, I might give them a big thumbs up. Oh, number 3, one of my favorites to get into if you've been following the channel. It is none other than AGNC Investment Corp, trading on the NASDAQ under the ticker AGNC. They are a REIT based in the United States and invests in residential mortgage pass-through securities and collateralized mortgage obligations. Their stock is down 19.55% over the past 5 years. Again, this is another company that we've covered in a few different videos, so we'll just give a really quick recap of AGNC.
The last 4 years, their revenue is down 120%. Earnings per share is down 68%. Shareholders have been diluted 53%.
But thankfully, there's a little bit of a silver lining, in their bottom line, or their free cash flow, has grown 38%. Oh, this is where the good stuff starts. Let's get into the dividend history. They started paying a monthly dividend of 22 cents in October of 2014. They cut to 20 cents in May of 2015. They cut to 18 cents in August of 2016, and they cut to 16 cents in May of 2019. Cutting's not done. They cut to 12 cents in April of 2020, where we're at today, until the next dividend cut. In 6 years, the dividend has been cut 45%. Obviously, dividend cuts will happen and things happen that we can't predict, but we want to buy companies that have a largely predictable growing dividend. That's what we're buying it for. There are fantastic companies that pay a reliably growing monthly dividend because they are strong companies. AGNC, in my opinion, is not a strong company right now. If they turn things around, I will fully retract that statement. But as things are today, there's no way there's no way I would buy AGNC. And I am out with a big thumbs down on AGNC. Number 2, Armor Residential REIT, trading on the New York Stock Exchange under the ticker ARR, is a company focusing on residential mortgage-backed securities in the United States. The stock has dropped 53.2% the last 5 years. Now, over the last 5 years, their revenue has been very volatile. In 2016 and 2020, their top line was negative triple-digit millions, while in 2017 and 2019, their revenue was north of $200 million. Over the last 4 years, earnings per share has dropped a whopping 185%. They've increased shares from 39,642 to 63,070, and the free cash flow has decreased a whopping 334% from 2017 to 2020. Yikes! Now, the dividend was raised from 4 cents to 33 cents in August of 2015, and then the cutting started. In April of 2016, it has been cut 5 times, down 70% to where it is today at 10 cents. I'm sorry, but if you're a dividend investor and you bought Armor Residential in April of 2016, your dividend income from this company has been cut 70%, while your ownership in the company has also been decreased by all the share dilution. So triple-digit drops in earnings per share and free cash flow over the 4 years, on top of a 70% dividend cut since April of 2016, on top of share dilution. This is pretty much the exact opposite of what I look for in a dividend growth company. And we are out of Armor Residential REIT with a massively big thumbs down. And the number 1 high-yielding monthly dividend stock that is recommended to buy now by Insider Monkey is Orchid Island Capital, trading under the New York Stock Exchange under the ticker ORC. ORC is a specialty finance company focusing on residential mortgage-backed securities in the United States. The stock is down a meager 54.47% the past 5 years. The last 4 years has seen Orchid Island's revenue steadily decline
3.8%.
Earnings per share has fallen 40% from 5 cents a share to 3 cents a share, with a big down year in 2018 and a big up year in 2019. And free cash flow has fallen 35%. Now, the big eye opener here for me with Orchid Capital is the share dilution. Going from almost 24,100 shares in 2016 to 67,211 in 2020. Now, ORC cut their dividend 6 times from 18 cents in June of 2015 to 5 cents in April of 2020. Now, that's a 72% erosion of dividend income. Yuck! But on the plus side, a small dividend increase in August of 2020 to where it is currently at today of 6.5 cents. And ORC is just another in a long line of monthly paying dividend companies that I am staying far away from. There's a reason why our favorite is Realty Income, ticker symbol O. We love Realty Income. They are a monthly dividend payer, and there is a reason why they are at $70 a share, and some of these are at $10 and $4 and under $20 a share. The lesson here is that you can use these for ideas, but you always have to do your own due diligence and know why you're buying something. It is incredibly easy to buy, but extremely difficult to sell a stock. Many of these gurus and articles and people on Twitter and Facebook will tell you what to buy, when to buy, but they're not there holding your hand telling you when to sell, because selling is the hard part. Selling should only occur when your thesis for buying something has changed or is no longer there, or if you're trading, you have to know when you want to get out and what your target is before you buy. Have all that information handy. Don't just blindly buy because you read it or you heard it from someone. Monthly dividend stocks are notorious yield traps, so check out this video we did right here on yield traps, and I will talk to you there.